Hello, beautiful people. Welcome to another brand new episode of the IT Forex class. In this week's episode, we're actually going to be talking about risk management. And I'm pretty sure you'll agree with me that risk management is one of the three core pillar foundations which profitable Forex trading actually is built upon. Okay, so if for any reason you're able to get very good at technical charting, technical analysis, and charting the price charts, and doing your markups and all of that. And let's say you've got a very good psychology, trading psychology. You've worked on it, and eventually you've been able to have a rock solid psychology. But then, let's say your risk management is all over the place. You haven't taken the time to really perfect it and hone it and make it bulletproof. Then you're still going to struggle. It's no news for any trader who knows what they're doing that you're still going to struggle to become a consistently profitable trader, because trading isn't just about technical analysis or having the right strategy or all of that. You also need to couple that with proper risk management. In fact, when you boil it down to the core of it, okay, a trader is pretty much a risk manager, because whenever you participate in speculating within the market, you're engaging in an act that relies on probability and uncertainties. And so if you don't properly manage your risk, then you're going to find it extremely difficult to become profitable. Okay. And that's why risk management is a very, very, very important topic, which traders, especially traders who are struggling to become profitable, really need to grasp. Okay. And the sad thing is that a lot of traders, especially beginners who are getting involved with trading, this is one of the things that they don't even know about. One of those things that they tell you that you don't know what you don't know. When most traders begin trading the markets, instead of taking the time to learn, how to properly manage risk, how to know that you're not going to be right 100% of the time, all of those things, they tend to focus their attention on trying to find the trading strategy which will give them winning trades 100% of the time. I did this. A lot of traders who get involved with the markets, especially through the influence of those gurus or mentors who don't really have your best at heart, you usually not get exposed to this from the get-go, from the onset. Okay, and so this is one of the reasons why I thought this is a topic we need to revisit, not because some of you, especially the intermediate traders, not because you don't know it, but because you might need a refresher to see its importance, and it's the reason why you need to really hone it to become a consistently profitable trader. So again, that might have been a long-winded intro, and let's just dive right into it, okay? So, first things first. What is risk management? Here are a couple of notes that I have gotten down to make the class easy for us to go through. Okay, so what is risk management? By definition, risk management is pretty much you controlling how much you lose and not just chasing profits whenever you take a trade. Okay, so what do I mean by controlling how much you lose? Let me give you a quick example. It is not uncommon for you to find inexperienced traders worrying more about how much they're going to make on the trade they take if it goes into profit, as opposed to worrying about how much they're actually risking in order to make the profits that they want to make. But the truth of the matter is, they're actually doing it all wrong, because how professional traders approach trading is they tend to worry more about what they're risking as opposed to what they are going to make from a trading position, because they understand that whenever they take a trade, it's not as if that trade is guaranteed to win, no matter how good a trading setup looks like, no matter how many confluences it gives them, no matter how many things tell them that price is going to do one thing, as opposed to doing the opposite. They know that it only takes one trader somewhere to negate the positive edge of their trading strategy or trading system or methodology. Okay, so again, one of the things you need to understand is that the main reason why you're practicing proper risk management is for you to stay in the game long enough to win. And what I mean by staying in the game long enough to win is that when you're taking trades, let's assume that you're doing it professionally based on the rules of a given trading strategy, for example, then you understand that the distribution between the wins and losses of the trades you're taking based on your trading strategy is actually random. So, for example, let's say you found a trading strategy that works for you and you've back tested it, you've tested it, you've tested it on a live account, and you've proven that all through the stages that it's actually a profitable trading strategy. Even though it's profitable, and just for example, let's even assume that it has a 50% win rate. Okay, so on average, you'd win, half of the trades you take, and you lose half of the trades you take. Okay, that does not mean that if you take 100, let's even make it simpler. If you take like 10 trades, for example, that does not necessarily mean that even though subconsciously this is what we hope for, that does not mean that you're going to take these 10 trades and then because it has a 50% win rate, the strategy you're using, that is, you're going to have a winning trade followed by a losing trade followed by another winning trade and then a losing trade, over and over and over again like this, okay, alternating like this. It's actually not like that. Probabilities don't work like that. What you're usually going to find is that your wins and your losses are going to be in clusters. Okay, so you might have a losing streak, which would then be broken by, a little winning streak here and there, and then maybe a series of alternating wins and losses and all of that, and then maybe a cluster of wins. So you might have win, 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 loss, 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 win, loss, win, loss, win, win, win. It's all over the place like that. But then after taking a large number of trades, for example, like 100 trades, the win rates that you're going to have is going to be close to what your average is. Okay, like 50%. Now, the thing is, if you're trading with a strategy that's got a 50% win rate, and then you're doing proper risk management by keeping your risk consistent. What I mean by keeping your risk consistent is whenever you take a trade, you're risking, let's say, for example, you're risking 1% of your trading account's capital on each and every trade you take. That's a constant risk that you're doing. We're using a simple risk management routine here. No, dynamic risk management, like when you're in profits, you go aggressive, and when you're in losses, you decrease your risk and all of that. It's a simple standard 1% risk per trade for every trade setup you take. Okay? Now, assuming you're risking 1% on each and every trade you take, and your trading strategy has a win rate of 50%, like we said, for example, if whenever you win, you're winning 1%, and whenever you lose, you're losing 1% because you're risking 1% to make 1%, meaning you're trading with a risk to reward ratio of like 1:1, okay? Then at the end of the day, because you're using a risk to reward ratio of 1:1, and you only have a 50% win rate, you're going to pretty much be at break even. You would not have made any money, and you would not have lost a lot of money. So you wouldn't make much because whenever you risk one, you're aiming to make one, and you have a 50% win rate. So it's like a flip of a coin. You're not making much, you're not losing much. You're just, hovering around break even. But here's where the numbers start to get interesting. Let's assume it's still that same trading strategy that's got a 50% win rate. But then now, the only thing that has changed, meaning your risk management, we're still doing that standard risk 1% per trade on any trade you take. But then the only thing that has changed now is that you're trading with a positive risk to reward ratio, meaning whenever you're risking 1, for example, 1% of your trading account's capital, your profit target, what you're aiming to make is 2%. So whenever you're risking 1, you're aiming to make 2. Now, with that same 50% win rate, let's assume you took 100 trades, okay? And of those 100 trades that you took, you only write 50% of the time, hence your 50% win rate. So you would have lost 50 trades and you would have won 50 trades. Now, for the 50 trades that you would have lost, each one of them, you would have incurred a loss of 1% on each of those losing trades. So 50 losing trades times 1% loss on each trade, losing trade that you take, then you're going to end up with, let's say, minus 1% here. Let's do minus 1% times 50 trades. Your gross loss is going to be minus 50%. But then, remember, each winning trade you took gave you a profit of 2%. And based on the sample size we're using for our example here, which is 100 trades, your win rate is 50%. So you would have won 50 trades. Now, for the 50 trades you won, each one brought a profit of 2%. So it's going to be 2 times 50. Now, when you multiply 2 times 50, your gross profit is going to be 100%. Now, when you subtract your gross loss, which is minus 50%, from your gross profit, you'd end up with a net profit, ROI, of 50% at the end of the day. So even though you were only right 50% of the time, meaning you lost as many trades as you won. The main difference here is that when you are trading with a 1:1 risk to reward ratio and you won 50 trades and lost 50 trades, you didn't really have an edge, and that was why you were hovering around break even. Okay, but then when you switched just one thing up here, which is your risk to reward ratio in this example, so that whenever you win a trade, you're winning 2 times what you're risking on average. This was able to make you a 50% net profit on your trading account. So you see the importance of risk management. It's not as if you won more trades than you lost. In fact, you won as just half the trades you lost. Half the trades you took, and you lost half the trades you took. But because you tweaked the numbers a little bit in your favor, you still ended up making a very, very good amount of profit. Okay? So this is one of the reasons why risk management is so important. Okay? But then there's a reason why there's something I want to draw your attention to. And that's the fact that the reason why we're able to make this profit in this particular example is because your risk was actually fixed. Meaning we're anticipating, or we're assuming that you were trading with proper risk management and the right psychology. Because this does not take into account the fact that, let's say, you took 100 trades in this particular sample size, which we're using as an example, right? But then, let's say when you started taking those trades, the first 10 trades you took were all losing trades. So you took the first trade, it was a losing trade. Second trade, losing trade. Third trade, losing trade. All the way to the 10th trade. But then, because you don't have good psychology and you just experienced 10 losing trades in a row, let's assume that now your psyche is all messed up and you've started doubting your trading strategy. You started getting angry because you've lost about 10% of your trading account's capital. You're down like 10% now, and so you want to make back, what you lost as fast as possible. So you start revenge trading. Instead of you keeping your risk per trade to that fixed 1% of your trading account starting balance and let the numbers and the probabilities work themselves out, so that eventually when you get those winning trades, they will pay for the losses that you took and give you extra profits in the process. Let's say your psychology got messed up and you now started trading emotionally. So you started making all of the emotional trading decisions, all the emotional trading errors. So now you're getting angry because you've lost a couple of trades and now you're down. You want to make back what you lost as fast as possible. And so you are revenge trading. Instead of you keeping your risk per trade to 1% fixed, you're now risking, let's say, for example, you're risking 5%. Because you want to get just that one winning trade, which will give you 10% in profit, and then you'd make back everything you lost. Okay? But then when you took that trade with the 5% risk per trade, it also ended up being a losing trade. So instead of you being down just minus 11%, for example, because you had 11 losing trades in a row, because your 11th trade, you are risking minus 5%, now you're down minus 5% on a single trade. So you're down 15%. And now, because you've lost that trade, you're now maybe you're angry, maybe you're scared because you're scared to take the next trade and dig yourself deeper into the hole, and only for you to not take the next trade and to watch it pan out and turn into a profitable trade. So now you're not only angry that you've lost money on a couple of trades and you've lost more than you should because you got emotional and started revenge trading, but you're angry because you missed out on a trade which would have given you some profits to cover for some of the losses that you took because you got scared and all of that. So risk management, just like with the other two things that you need in trading to become a consistently profitable trader, the two other pillars, they need to work together. None of them can work in isolation here. The reason why I'm saying this is because you might think now that, okay, since my trading strategy is not as important as risk management and my psychology and all of that, you start focusing on, doing all of the wrong things, taking trades, and maybe you're not risking as much as you're not keeping your risk consistent and all of this. And then eventually you start making all of these emotional trading errors. Your emotions need to be in check. And the way to do that is to have a fixed risk protocol. If your risk per trade, especially when you're just getting started, you're not profitable, you're not, all the way up there, if your risk per trade is 1%, make sure it stays at 1%. Whether you are in a winning streak or you're in a losing streak, whether you're feeling emotional or you're not, whatever the case is, keep your risk consistent. Because if you don't keep it consistent and you increase your risk per trade on some trades and you decrease it on some other trades, then guess what? This edge that we just showed you as an example of you taking 100 trades and winning 50 and losing 50 and still ending up with a 50% profit, then it's not going to materialize. Because if you don't have the discipline to stick to the rules and stick to your plan, then some trades you might risk more and you might lose them, and some trades that would give you profitable trades, instead of you risking what you're supposed to risk, you might be fearful and risk less than you should, and so the profit would not be as big as you need it to be for it to cover for the losses that you take. So you need to have not only proper risk management, but the right psyche, the right psychology to actually execute your trading strategy or your trading edge without getting emotional in the process. Okay, so moving on. I just gave you an example of risk to reward ratio and keeping your risk consistent, and how being emotional would affect your risk management and the edge that your trading strategy gives you. But then there's something that a lot of traders don't know how to do, and that's after understanding the theory of why you need to keep your risk consistent, how much you need to risk per trade, like for example 1% on every trade you take and all of that. Some traders don't know how to do that in practice. And what I mean is, some traders might just hear that, okay, you need to risk 1% and you need to do all of this, but then when they go to place the trade, they don't know how to actually place a trade with that 1% risk, or placing a trade not risking more than 1% of your trading account's capital. And all that comes to how to calculate your lot size, which is otherwise known as position sizing. And so that's what I'm going to teach you how to do next. Okay, so let's move on with that. So what you need to do is just open Google or whatever search engine you're using, okay, and just type in position size calculator into the search bar. Okay, so let's go position size calculator. There are lots of them. There are lots of tools out there. Some you need to use a calculator like this, so I'm going to open a couple of them just to show you how to work your way around. Some you might even download EAs, which you could use to do your risk management calculation directly inside MetaTrader, but it's really simple once you get the gist of it. Okay, so let's quickly show you an example. Okay, let me quickly pick this. Okay, and the chart I'm having here is the chart of the GBP JPY currency pair. Okay, so let me quickly do this. So let's assume this is a trade setup that you're interested in taking. This is just a random example. Okay, so let's assume that based on what you've seen on the charts now, let's say you've just done your simple break and retest trading strategy analysis, and you've seen that price has gone from forming high highs and higher lows to now struggling to break above this resistance, and then all of a sudden now it's forming lows and lower highs, lower lows and lower highs. So you're anticipating that price is going to continue moving down as long as this downtrend remains intact. And so let's say you wanted to place this trade, a short trade, okay, somewhere around here, okay. Let's say when price breaks below this candle, for example, you want to place a short trade here, and your stop loss is going to be above this resistance, because if for whatever reason this lower high that price has printed here, if for whatever reason price goes from this area to break above this area, then we're no longer forming lower lows and lower highs. Okay, obviously price would have switched to whatever the case might be. So you don't want to be in that trade anymore, because you're taking the trade because you thought that downtrend is going to continue. Okay, this is just a simple example. Okay, now what I want you to notice is in TradingView, and to open an account with TradingView is free. So you could just do a Google search and open TradingView. This tool that I have on my chart here is called the long and short position tool. Okay, so when you're placing a trade, it shows you where you're going to be placing your stop loss and what your risk to reward ratio is going to be and all of that. For now, for what I've just drawn on my chart, you'd notice that we have the risk to reward risk/reward ratio, okay, and it's now at 0.42. This is a negative risk to reward ratio. The reason is because we're risking, based on what it is now, the distance between our trade entry, our supposed trade entry, to its stop loss is much more than the distance between our trade entry to our profit target. And especially if you're trading with a trading strategy that has a win rate which is like 50% or lower, you definitely don't want to be trading with a negative risk to reward ratio, meaning you don't want to be risking more than you are going to make on a trade, because if you're doing that, it's going to be extremely difficult for you to become profitable. But rather, if you're trading with a trading strategy that has a win rate which is lower than 50%, you want the profits from your winning trades on average to be much more than the losses that you take on your losing trades on average, because that's what's going to pay for the losses that you incur and give you extra profits in the process. Okay, so again, assuming we've done our analysis and everything, and our stop loss is supposed to be somewhere around here, when I double click on this tool here, you'd notice that this tool is telling us that the distance from our trade entry to our stop loss is around 822 points. This is not pips, by the way. This is points, because that's what TradingView uses for precision and whatever the case might be. Okay, so here it's 822, and just to round the numbers, make it easier for our calculations, I'm just going to make this 820. Now, for this to give us, let's say we want to aim for a 1:2 risk to reward ratio, meaning whenever we're risking 1, we want to make 2 times what we are risking if our trade was to hit our profit target. Then in this case, since the distance between our trade entry and our stop loss is around 820 points, then the distance between our trade entry and our profit target needs to be 820 times 2 for us, for the trade we are taking to hit a profit target, and then make us 2 times what we're risking. And that 2 times is going to be around, if I'm not mistaken, 800 times 2 is around 1006. 1006, 2 times, 20 times 2. So it's going to be 1640 points. Okay? For us to have a 1:2 risk to reward ratio, this is what our profit target level needs, the distance between our trade entry and our profit target level. This is what it needs to be. Now, you've seen that I've just typed it here inside TradingView, but I haven't clicked on OK or enter, and so it still hasn't reflected. Pay close attention to what happens when I click anywhere here or clicking on the OK button. You see? Now it has automatically adjusted, and it's telling us that our risk to reward ratio for this particular trade setup is 1:2, meaning 2. So we're risking 1 to make 2. Okay, if this was like 3 times, whatever the case might be, TradingView is going to make it easy for you to see it by showing you right here. So when I click on OK here, and let's say I don't want this to move around when I'm moving the charts or anything like that, when I click on it, I can click on this lock button, and then it's not going to move this particular tool. If not, it's going to keep moving and changing our trade entry and exit and all of those levels. So now, from what we've done here, you notice that our stop loss is supposed to be around the 213.117 price level. Our trade entry is meant to be around the 212.297 price level. And when I squeeze the charts a little bit, you would notice that our profit target for this particular setup would need to be around the 210.657 price level. Okay? Now, this is the setup. But remember, we haven't placed the trade. If, for example, you are trading with a $100,000 account, okay, and then 1% of that $100,000 will be $1,000. So you want it to be in such a way that if you're placing this trade, you'd risk no more than $1,000, so that if price was to hit your stop loss, you'd lose nothing more than $1,000 on that particular trade setup. But if you're lucky enough and price was to hit your profit target for the trade, you want to structure it just like we've had it here, so that you would make $2,000 in profit. Okay? Now, let's assume that you've done all of this and you want to place the trade. For you to place a trade inside MetaTrader so that you don't risk more than what you are intending to risk according to proper risk management rules, this is where using a position size calculator comes into play. Because without it, you're not going to know what lot size you're supposed to place that trade with, so that you don't risk more than the amount that you want to risk, as an example. So in this case, when you search the tool on Google, like I showed you, you can open any one of them, and it doesn't really matter, okay? Let's say you're using this one, for example. You need to input some details for the tool to be able to calculate whatever the lot size you're supposed to place that trade with profitably is going to tell you. The first thing that you'd want to do is to select what currency the account you're trading with is denominated in. So the balance in your trading account, is it in US dollars? If that's the case, just click on the USD option here and enter the other details and just move on with it. But if your account is denominated in euro, for example, or the Japanese yen, or the British pound, or Swiss franc, or Australian dollar, or any of those currency pairs, then select whichever currency pair your account is denominated in, and then you're done with this section of the calculator. In this field, you want to type in your account's balance. Remember, we used the example of trading on a $100,000 account. And so I've typed that in. And what are you risking? How much are you risking on the trade you're taking here? We said that our risk is 1% of our trading account starting balance. Now, the distance, remember, the distance between your trade entry and your stop loss, this is what we took the time to do based on this tool here, okay? And you remember that I told you that we entered 820 points. 820 points is not 820 pips, because a point is the smallest increment, like a pip or whatever the case might be, okay? So 820 points, if you want to convert it to pips, you need to divide it by 10. So as you can see, this tool is even telling us. That's why I told you this tool is actually very useful. If you want to use it, it's free. Just open an account with TradingView and you'd find it somewhere around here, the long and short tool. It's somewhere around here. You see? Long position tool, short position tool, okay? So you can see that this tool is telling us that this particular trade setup, the distance between our trade entry to our stop loss is 82 pips, not 820 pips, 82 pips. But if you're calling it in points, it's 820 points. So now we know the distance between our trade entry and our stop loss, which is 82 pips in this example. So you'd go back to the position size calculator and type 82 pips here. That's what it's asking you in this stop loss field, okay? So you type that here. And then the last thing you need to do is, what currency pair is the setup that you just identified? What currency pair are you trading? For this example, remember, we're trading the GBP JPY currency pair. Okay. Now the tool is going to ask you, what is the current ask price of the USD JPY currency pair? Because it needs to do that so that it's going to give it the proper lot size calculation, because it depends on the ask price of the USD JPY currency pair. So here you just go back to the tool, click on this market watch window, and you can see that the ask price of this pair, I think it should be around, let's say 160.40, or let's just say 160.40. Okay, because it keeps fluctuating. So let's say 160.40, 160.40. Then you, after you've entered all of these details that the tools require here, notice that the results, because we haven't clicked on the calculator button, calculate button yet, is showing us everything is 0. Okay, so when I click on the calculate button, you can see that this tool is telling us that, okay, for you to place a trade inside your trading account that has $100,000 as its balance, for you to place a trade so that you don't risk more than 1% of that trading account starting balance, which in this case is $1,000, you need to place that trade with a lot size of 1.95 if the trading account you're trading on is a standard account, meaning every single standard lot you're trading on that account, the value of a pip for that account is like $10 for currency pairs like the Euro USD or whatever the case might be. But if you're trading on a mini account, you need to place that same trade with a lot size of 19.56 for you to actually risk $1,000 on that particular account. And if you're trading with a micro account or a cent account, as they are otherwise known, you need to place that same trade with a lot size of 195.60. So this is really as simple as this, okay? But then this method of using this, doing your lot size calculation and risk management is a bit tedious, because you need to use TradingView, mark up your trades, get the distance between your trade entry and your stop loss. Doing all of this, especially if you're day trading or scalping or all of those things, it takes time that before you might even place the trade setup, this move might have even moved without you. Okay, if you're swing trading, then this doesn't take all that much time. You can do it this way, it's no problem. Okay, and this leads us to the tool that I would highly recommend you use to do this thing. Okay, and so let's use, the name of the EA is Position Sizer. Okay, Position Sizer EA. It's completely free. Okay, and this tool, you would install it inside MetaTrader, and then it's going to calculate the lot size, everything that you want to use to place a trade. It's going to do all of that calculation for you inside MetaTrader without you having to leave MetaTrader or go to all of these websites and use these tools. Once you've done all of your calculation, you can even just click on a button and then it's going to place the trade for you. This is what the tool looks like. So it's going to ask you for your trade entry, and you might even move it with your lines and all of that. And let me quickly even show you an example of what it looks like in real time, okay? So this is an account that I'm trading, and you can see this is the position size. I already have it here. So I've already configured the trades I want. If I want, I could just click on show lines, and then this tool is going to show me, okay, this is my entry. If this is where I want my entry to be, then this is where it's going to be. If this is where I want my stop loss to be, this is where it's going to be. Here, I'll just type in how much I want to risk per trade. And then here, if I want to place the trade, I just click on trade. Okay, and it's going to even ask me for confirmation. So I want to place a trade here. This is what I'm going to be risking. This is where my entry is going to, everything. It does it automatically for you, and it makes everything very, very easy to execute. Okay, so this is the tool I would recommend for you to do proper risk management. And for you to do that, just go to the site, and they have a full-on documentation which is going to show you exactly how to install the tool, set it up, and tutorials on how to use it and everything. And it's 100% free. In fact, on MQL5, there are tools for position size calculations which are not as good as this tool, but they charge you like $100 or some even more than that to do the same thing. But it's free here, so that's why I'm even showing it to you. Just go out there, search it on Google, Position Sizer EA, download it and follow the instructions to install it and start doing your proper risk management, okay? Because like I told you, you might have the best trading strategy in the world, but if you don't have proper risk management and the right mindset, you're going to struggle to become profitable. So you need all three. You need proper risk management, having the right trading psychology, and a good trading strategy that's going to give you an edge over the market, so that you're going to make more profits than you lose on, as long as you're taking the trades you take, and eventually you're going to end up being profitable. So please make sure to go and download the tool, install it. It's free, by the way, okay? So before we wrap up this class, and I seriously hope that you guys got a ton of value from it, because risk management is one thing that you really don't want to play with, because yes, you're not going to get rich overnight, but if you don't use proper risk management, then you might not even get rich at all, because you could blow your account somewhere along the line, okay? So please, this is very important. But before we wrap up the class, please make sure to reach out to us if you're interested in using any of our tools to trade on your behalf, to find low risk, high probability trading opportunities for you, and then place those trades for you and start getting you to earn while you're learning how to trade, diversifying your portfolio, which is the right thing to do, okay? So if you're interested in it, please reach out to us on any one of our social handles or drop a question in the comment section, and we'll be more than happy to walk you through how to set everything up step by step using our recommendations, okay? Once again, thank you for taking time out of your busy schedule to attend these classes. I sincerely appreciate it, and I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers.